Hey there, great people. Thanks so much for dialing in. Touching base to let you know that as with all of our content, this is general in nature. It does not take into account your specific or personal circumstances nor your individual risk profile, and as such should not be acted on accordingly. If you get value from this and you want to explore some things further, I strongly recommend that you get personal advice from a qualified professional. Today, I'm thrilled to be joined by AMP Deputy Chief Economist Diana Mousina. On Liberation Day, luckily enough, Diana has a real knack for translating complex economic topics and distilling them down into easily to digest information and everyday language, making her a brilliant guide when it comes to economic information. This is particularly of interest for those of us building our wealth or even just starting out on your investment journey. All right, hello and welcome, Diana Mousina, Deputy Chief Economist, AMP Capital. Thanks for joining us, Diana.
Thank you. Thanks so much for having me.
Now, Diana, before I get into the nitty gritty, we're very lucky to have you today, but I was just hoping to reverse over just a bit about your origin story, how you got into economics, what you've been doing previously, just help our listeners understand a bit of your origin story.
Oh, well, I'd say I've had a pretty boring sort of career journey because it's been quite linear, which I do normally tend to find happens in something that's so, I guess, a bit niche and a bit academic, like economics, where the history and the research that you've done really does help you to progress your career. So I started out as a graduate at the Commonwealth Bank on the graduate program, and in that time I was in equities research, and I met the economics team through that, and I really liked what they did, and I sort of always wanted to potentially go down the economics path, and I eventually got a rotation in that team, and then there was a job going at the time. So lucky I just slotted in. So it was quite a good transition from the grad program. And then I had about 5 years at CBA in the markets team. So it was sell-side economics. And then I moved to AMP Capital at the time. And then we transitioned into AMP a few years ago. So it's been about 9 years at AMP working as an economist. So my whole career I've actually been an economist, but the world's been so fluid since 2020 that it's been quite an exciting time to be an analyst. Before that time, looking back, things were really boring. The RBA wasn't doing anything, and there was much less to talk about globally. So it's definitely been an interesting time to build up my skills the last few years.
Yeah, brilliant. And my experience in the game is roughly 16 years advising, and I generally think of economists as cardigan wearers, a little bit boring to listen to. And I've been following along a lot of your content and information, and I would say you're sort of breaking the mold a bit. So
thank you.
I just want to sort of get it. How do you sort of go about approaching that?
Yeah. Look, I think I've always liked to break economic concepts down into a way that I can relate to, understand myself. And I do find that there is a lot of jargon in the economics world, and it sort of makes people's eyes glaze over a bit when you're doing presentations if you sort of get too specific or talk about concepts that people don't really have much experience with, because there is a lot of background knowledge that a lot of economists assume people have, like, does everyone on the street know what the trimmed mean inflation is? No, and nor should they. Yeah. You have to sort of explain things to people in a way that is relatable to them. And I think a lot of people feel like economics is not relatable to them because they don't understand how it actually impacts them or how it works. So it's sort of seen as like this, that people say economists, they're in their ivory tower. They're just sitting there sort of looking at things, but they don't actually understand what real people are feeling. So I think I just tried to connect that theory with actually how people feel. And I hope I can do that through things like the videos and our research. And of course, there's a time and place for different economists. Like for example, if you are working at the Reserve Bank, well, you do need to be quite specific as to one area that you're focusing on. If you're working at the Treasury, you're doing forecasts. There is definitely a time and place to be more of potentially the cardigan wearing. Not that I'm saying there's places wear cardigans, but to be more of the traditional type of economist role. But I do think that market-based people and people in the media need to explain things a bit better so that everyday people can understand them.
Okay. So RBA cardigan wearers, AMP cap fun. So, and just for the layperson, like, what does an economist do day to day, or actually in your role? Just help us sort of understand that.
So we basically look at data every single day that comes out. So around the world, every single day, there's always some sort of data releases out there, whether it's in Australia, we might get inflation figures or GDP growth in the US. There might be housing data. There might be PMIs. There might be inflation as well. So we would basically look at everything that's coming out, not just data, but actually politics as well, some announcements, central banks. And then we try to make sense of what's going on around the world through that data. We write reports based on that. We update charts. We talk to clients. We talk to the media. That's basically, a day in a nutshell, is understanding the data, putting it together in a way that we could communicate to people, and then talking to people directly about that as well.
Yeah, and then that helps us all make decisions as well on what we're doing.
Well, that's fundamentally the goal, right?
Yeah.
So you want whatever you think is going to happen around the world to sort of impact people's financial decisions. And working at a super fund, you sort of do have more of that direct relationship as to how do your macroeconomic views actually impact people's portfolios, which in more of a sell-side traditional economics role, you probably wouldn't. You'll just be out there trying to talk about what you think is going to happen, or that, that traders might make decisions based on that. And I guess economists also can change market perceptions of things, like how much is the market pricing for RBA rate cuts or hikes or whatever it is. So you can sort of influence market pricing.
Yeah, gotcha. And so just jumping into the current climate, how would you describe the current climate? Super interesting.
People feel quite concerned about the current climate, and for good reason. I mean, the share market has fallen by more than 10% now from its peak. In the US and Australia has been similar. So we're sort of into that territory where people are worried that it's going to be a serious bear market, where shares can fall by 15, 20%, potentially even more. Concern about a recession is very high. And that's understandable because we've seen a bit of slowing in some of the US economic figures. So they're obviously going through a bit of a cyclical slowdown. And on top of that, there are these policy uncertainties there around tariffs, around the firing of federal government employees, the reduction in the population growth. So I understand people's uncertainty that they're feeling. But that's basically the concern that's going on in share markets. For the Australian economy, though, I'd actually say things are improving slowly, and we've had pretty poor growth outcomes in the last 2 years. No, it sort of doesn't really feel like that overall, but then at the same time, we haven't had a proper recession in Australia for about 30 years. So people always tell me, well, things never feel that bad. Now I'm still going out and shopping or eating out with my friends or whatever. So I don't really feel like we're actually in a downturn. But for the private sector, things have been pretty soft in the last 2 years. We've had poor GDP growth. The public sector has really been the one that's been supporting the economy. But the private sector jobs market, especially in the last 12 months, hasn't been particularly strong. So we can definitely see some of that pain in the private corporate world. Business investment growth has been soft as well, but the consumer is turning around in Australia. We've had rate cuts, we've had tax cuts, we've had lower inflation, and this is all quite positive for consumer purchasing power. And I think the next 12 months should continue to be positive, even though we have this global uncertainty that sort of clouds potentially the investment outlook here. But I think for the economy as it stands, we are not directly impacted by a lot of these tariffs. I mean, we do have a direct tariff that's imposed in Australia, but we don't have a large exporting relationship with the US. It's about $24 billion worth of goods. We can weather the storm of a 10% tariff increase.
Gotcha. So today is a big day with tariffs, make America great again. So, and that's a real buzzword at the minute. Every man and their dog is talking about tariffs. So I'm just hoping we can reverse back over that. Can you help us unpack what's the go of these tariffs? Why are they important for global and local economic stuff?
Okay, yeah. So firstly, what is a tariff basically? The Trump team keep on saying the tariffs are bought, that global countries pay the US basically for tariffs. it's not really how it works. A tariff is imposed on an import that comes into the US, and the importer pays that higher rate. So then the importer decides, well, do I want to pass this down to the supply chain? Of course they do, because they can't just absorb these high costs. I guess some people think, well, maybe the exporting country might reduce its prices potentially to account for these tariffs, but that doesn't tend to usually happen. What usually happens is the importer passes it down the supply chain fundamentally to the consumer. And history tells us that tariffs have been inflationary to consumers. So the concern that markets have is that with high tariffs mean high prices for consumers, mean lower spending in the US economy, lower global trade growth, that's poor for GDP growth and global activity, and that it will derail the potential cutting process if the Federal Reserve becomes concerned that we're going into an inflationary period again, a higher inflationary period, or if we get or there's concern that we might be going into a significant downturn. So that's why the market is concerned about tariffs. We don't really know how bad it could get, although I think we sort of have a bit of clarity, more clarity around that after the Liberation Day announcements. And we also, I guess, don't know how other countries will retaliate. That's probably the more important thing. And if other countries retaliate with their own tariffs, then you could start the process of continuing to bid up global prices, which would be a bigger negative for consumers and for global trade. Now, that would really set us down the path of worse GDP growth and market outcomes for shares.
Okay, and so potential flow-on effect to things like inflation and making it hockey stick back up, is that a real risk?
So if there was just one tariff that was imposed, that would normally just be like a levels adjustment. So you get a one-off increase. Yep. But the concern with the retaliatory tariffs is you might get a few periods of high prices. So you have this continual step up to goods inflation. I think fundamentally the Federal Reserve would probably look through a bit of that noise. And if there was a need to support the economy because it was slowing down from poor performance around trade, softer growth, I don't think it would worry about the level change in one-off prices. I think it would step in to support the economy through further rate cuts. I do think that the Fed will cut rates a few more times this year.
Yeah, okay, great. So there's a few more levers to be pulled outside of the tariff side of things that could help with these other areas. And have we had a point in history where tariffs have been such a hot button topic before that you know of, Diana?
Well, back in the 1930s, can't say I was around then to remember that period. That was the time that the US had extremely high tariffs. So back then, that was the Smoot-Hawley Tariff Acts. Tariffs were around 20% on average in the US. With the announcements today, our estimate is that they're going to go to around 25% or so, potentially more, because the Trump team has said that they're going to announce more sector tariffs probably next week. So there is unfortunately more to come. But that would take the average US tariff rate basically to its highest level in 100 years. So it is a very big increase from where we've been.
Okay. And what happened out of the back end of those tariffs, do you know? Was it did markets rise? Did we have a period of stagnation? What happened?
Well, we did have a period of softer GDP growth at the time, but it also coincided with periods of war. The market was not as, I guess, financialized as it is now. We didn't have inflation targeting. We didn't have the central banks moving to support markets. So I don't think we can sort of relate that time to the current time. I think things are quite different, and that sort of reminds me back of when we had the high inflation in 2022, and a lot of people were relating what happened in the 1970s, even back to a few years ago. But I think that the world has really changed in the last 20 years. We have become much more reliant on central banks and the government to step in when we need them to. We're much more sort of addicted to share markets and it's sort of a highly financialized world. And I think that there is some sense of a bit of Tina. There is no alternative that's baked into markets. So I think, I just think that things are a little bit different. It's hard to correlate one time to another, particularly at a time like the 1930s. Obviously, the 1970s was not that long ago.
Yeah, gotcha. And just sort of, it's a great explanation around tariffs and how they might or might not impact and overall what they're trying to achieve with it. coming back onto our shores, you've raised a few things around with Australia. I just want to ask things like the election and our CPI reads. What do you sort of see for us moving forward? Just in a broader market sense, and also interest rate is a hot button one as well for everyone here.
I think our growth numbers are going to start improving to about 1.5% to 2% in the next 12 months. We've been running a GDP growth of 1 to 1.5% the last 12 to 18 months, which is quite poor for Australia. So the consumer outlook is better. I'm hoping that the business investment outlook turns around a bit as well. Our inflation figures have a bit further to fall. We've had quite high services inflation. I think that's going to start. It has already reduced a lot, but I think it's got a bit more downside to it, particularly for things in housing. So for things like rents, we've had another round of electricity rebate, the cost of living stuff that was done by the government. So that will reduce headline inflation. I think even if the coalition wins the election, that they will still extend those things. We're probably going to have some lower inflation around medical costs and healthcare and education. So I think that will help to slow services down. So I don't think we've got an inflation problem. Inflation the next 5 years is probably going to be a bit higher than where it was before the pandemic. So our forecast that it will average between 2.5 to 2.75 or so in the next 5 years. So not back down to 2% where it was in the decade prior to COVID.
Yeah.
So that means that we will get some more rate cut relief because the inflation outlook allows us to have that, but don't expect rates to fall that much. So we're talking about potentially interest rates bottoming at 3.1%. We're currently at 4.1%, so only really another percent down from here. In the big scheme of things, that's a pretty shallow cutting cycle.
Well, compared to the tightening of the
well, that's right. No, we tightened from
0.1
to 4.35%, and it was a very severe tightening cycle.
But I think just on that, if we do come back anywhere around that 1%, I think that's more normal than what we had. If you look at the history of rates and so forth, we're enjoying our home loan rates in the 2s, but that was actually the abnormal period.
That was the outlier. I don't think that 10 years before the pandemic, or the period after the GFC, that was it was a strange period. Inflation was too low, interest rates were too low. We had no fiscal stimulus, so it's hard to see that being repeated again.
Okay, yep. And in terms of the election, does that have much impact on markets? Yep.
Historically, the Australian election has had no impact on markets in Australia. Maybe a little bit on the Aussie dollar, but I think what's going on globally is probably a bit more important for the Aussie dollar. I suppose the reason that the election is less important in Australia than something like the US is because we do have more moderate parties. So because we have compulsory voting, people tend to moderate their policies to the centre. So even if you look at the difference between Labor and Liberal policies, there's really nothing in them that sort of makes me excited or even concerned about the Australian economy from here. Whoever wins, I don't think it's going to make a big difference to our trajectory. Obviously, they have some different policies, and people feel strongly about the different parties. But I don't think that we're talking about severe policies like we're seeing in the US, where you actually have some fundamental structural change. The differences in policies are quite small in Australia.
Yeah. Okay, great. And so just as a broad-based summary, for long-term investors, should they be particularly worried about the current climate, or is it more just sort of shoulder to the wheel, stick to your strategy, history repeats and we'll be okay in the long run?
I suppose the difficulty now is that we don't have really another period in recent history where we can see the impacts of high tariffs. So I do think that the risk is that we will see more downside to shares. We are currently thinking that we will have another 5 to 10% drawdown from here. So getting into those territories where investors will start being concerned about the outlook. And fundamentally, we don't see a recession occurring, although it's probably now about a 40% risk of a US recession. And we know that when US recessions happen, that's when the worst share market outcomes occur. So I do think investors should be expecting more downside from here. But on a 12 to 18-month view, I still think that there's reasons to be optimistic. And the reasons to be optimistic are that we're going to see some rate cuts continuing. The US economy has been in a strong position, and I think it can weather some of the impacts from high tariffs. I also think that some of Trump's other policies around trying to reduce income taxation significantly, reducing the corporate tax rate, trying to get business investment growth up, that has positive implications for growth. And that could start to come through in a year and a half's time. The Trump administration is very serious about the tariffs, but also, they may potentially get what they want around more investment directly into the US. So I sort of think, yes, it's bad in the short term. There's more downside, but I don't see this as a long-lasting negative that's going to continue hurting markets. And there are still very profitable companies in the US. There's still reasons to be optimistic around profit growth in particular sectors. So on a 12-month view, I think returns from shares will be positive again, but we should expect more downside in the short term for sure.
Okay, brilliant. Sounds like there might be some really good opportunities for
that,
those
and that's
brave
why
enough.
I think for those brave enough to dip their feet in, and for long-term investors, I think that there will be some opportunities.
Yep, and it also sounds like we might get a bit of relief in the hip pocket as well in the next year or two. So that would be
would
great
be good
as well.
news.
And so from your perspective, are there any tools or information that you find easily to digest that you think investors should tune into? Because there's a lot of noise out there at the moment.
Yeah, we have a podcast called Simplifying Investing, which is done by our team. So Shane Oliver's our chief economist. There's myself, and then there's another economist called Me Boy. We talk on the podcast every 2 weeks about what's happening with markets, what's happening in economic data. It's a really good way to stay informed. There's also our publications that can help you stay informed. We do a weekly. We do updates about the key economic data. We do thematic deep dives into things, so you can subscribe to that. And you can also follow us on all the social media channels. We're called Econosites. We're on TikTok and Instagram, or you can follow us on LinkedIn. And we post educational videos, sometimes funny, sometimes a bit serious, to sort of keep people up to date about what's going on in the economics world in a way that's easy to understand.
Yeah, I can vouch for Econo Insights. I'm a keen reader of that, and also your LinkedIn profile. So certainly no cardigan wearing content there. So
Thanks,
very good. So Diana, I really want to thank you for your time. I know today's probably really busy for you with Liberation Day, but you carving out a bit of time to chat to me is very welcome. Your insights are a breath of fresh air, I reckon. So thanks so much for dialing in, and we'll keep an eye out for your content.
Thanks so much.
Forward.
I appreciate you having me on.
Thank you. So if you found this valuable, you're very welcome to share this content with a friend or colleague that you think might also find this valuable. And of course, if you've got content, guests or topics you'd like us to cover off on next time, drop us a line and we'll endeavour to get them done.